Hey everybody, welcome to the Option Pit Market Show Live. I'm Hans Albrecht. I'm your host for today. I'm guest hosting. The head honchos are busy doing very, very important stuff. So I wanted to just put out a video for you guys, and I figured, why don't we do it live? Let's talk about things as they happen in real time. Of course, we'll talk a little bit about how we're getting here, right? We've had this incredible market. I'm going to share with you my screen here showing you what I like to call the running of the bulls. Here we are, we're the running of the bulls. This market has been unbelievably strong and bullish, and we can see this guy's getting gouged here. This is probably what a short feels like the last few months. So it hasn't been very much fun. There have been unique opportunities in the market to make money on shorts, and one of those has been shorting volatility. So, and at Option Pit, we've been really, really nailing that vol crush trade, right? So you really have to learn to kind of pivot when you need to, and look at the market as it is at any given time. And there have been wonderful opportunities. We went through this long period there where we were VIX 20, even though the market was doing nothing. And now the market isn't really doing anything all that much, except pretty much going up. And that has led us to sort of this low volatility environment, which I'm going to talk about in a moment. I started to get a little bit nervous this weekend. I've been tweeting about how that low realized volatility, right? So realize, what does that mean? That means actual volatility. So let's take a look at volatility here. So the blue line is your realized. So that just means actual volatility. It looks into the past. It says, okay, what has the market been doing? Implied volatility, which is the option pricing that you guys see out there. If you're buying options, you're selling options, you're basically trying to monetize somebody's sentiment if you're selling options, and if you're buying options, you're hoping that that price is a fair price for what you've paid for a movement going forward. So option pricing is everything going forward, realizes everything going backwards. So looking into the past. And we can see that when we get down to this level of short-term volatility under 5, it never lasts for very long. And I think we kind of entered into the kind of environment yesterday where we just kind of started two things. We started getting into that very, very low realize, which doesn't last. And we needed a little bit of a pullback to kind of clean the slate a little bit and get us back into, just bring off a little bit of that fluffiness that we've been seeing. A lot of parabolas out there, right? We've been seeing all kinds of stocks, from speculative ones to even safe-ish type stocks, really kind of going parabolic. And we saw a little bit of that pullback yesterday. Momentum really, really took a little bit of a hit. So let's take a look at the momentum trade here. Momentum, 1 day percentage, really, really, really big pullback in momentum. You know what I'm talking about, the stocks like Reddit, which I think is a great company, but many, many stocks just kind of having that parabolic move, giving back a little bit yesterday, just a little bit of a blow off top that we've seen, a bit of speculative kind of fervor out there. So we saw a good pullback in some of those names, but I would say that it wasn't necessarily in the growth in general. We saw MAG names, or Magnificent Seven names, do quite well. Microsoft did well. Amazon's not far from its all-time highs. Meta pulled back a little bit, but it's pretty much trading near its all-time highs. And Tesla hit 400 before we pulled back to that 380 level, which, by the way, is where we were hammering out some puts. We sold some puts in Tesla, in Meta, looking for those really, really strong names that we've seen just kind of push higher relentlessly later, reasonable valuations, right? Like a Meta, I mean, to the extent that you can put valuation on short-term moves, Meta trading at 25 times forward earnings, really not an expensive stock, right? So people keep talking about how bubbly everything is, maybe in certain areas, right? But in general, we're still seeing some reasonable value. And going into the end of the year, seasonal strength, corporate buybacks, CTA buying, and vol targeting buying. So what is that? Well, these are funds that basically buy more of the market as volatility comes down. So they were risk off back in the election days, and now as volatility comes down, they have to plow more more money back into the market. And so that creates support, right? It's kind of this positive loop, right? They're buying stock because the volatility is low, and buying stock lowers volatility, and then volatility gets lower, so they've got to buy more stock. So it's kind of this positive reinforcement loop that can really work. And so these are these products that we really have to be aware of these days, all these things that didn't exist 15, 20 years ago, right? When I started as a market maker, I was a pro market maker for 12 years in options. And, what we did was inconsequential. It didn't matter to the market, if we were trading, a few thousand contracts. These days, this is huge, huge business. So the tail used to be the options wagging the dog, which was the market. The option market is really, and the derivatives market in general, is becoming the dog, right? It is becoming the thing that everybody watches because there's such a huge influence from those various kinds of products. If I can show you this, for example, look at the derivatives income AUM over the last 5 years. Forget about the last 15, 20 years. Look at what's happened since 2020. Just unbelievable growth in these funds. We know cover call funds, various things, caller funds, buffer funds, these things that you might have heard about. And we'll talk about the JPM caller in a moment because it pertains right to this. Look at the growth since 2020, 4 or 5 billion in AUM in embedded option selling strategies. So ETFs out there that are selling options in order to generate that extra yield, that extra income, right? The Tesla one, the Nvidia one, but then the broader ones, that there are some very big funds out there, 13, 15 billion dollars that are doing this. 5 billion in AUM, all the way up to $100 billion in these products. This is big business. Options are huge, huge business, and therefore very influential and important to the entire market. So even if you're not an options trader, this is the kind of stuff that you need to be aware of because it should inform your strategies to some extent, right? If you know gamma levels, for example, and right now, let's talk about that JPM caller. We had a strong move, which I've been calling for a couple months, strong move up to that 60.55 caller. What's a caller? When somebody sells, they're long the market, they sell an upside call, and they use that premium to finance a downside put or a downside put spread. There's a massive fund out there, a number of funds that do this. And last time was the end of September, we moved right into that collar, and big positions like that tend to be a clamp on volatility. And it's the reasons for that, probably too much to get into for our purposes here today, but basically market makers, dealers are buying and selling stock above the strike, below the strike, sometimes doing the opposite, below the strike. Sometimes they'll sell depending on how much time is left. But the simple meaning of that is when you have a lot of positive gamma, markets can get less volatile. And when you have negative gamma, you can get an accelerant to movement. And so without getting too deep into it, this is where the market is sitting today, right? We kind of blew through that in the past week and a half, that call strike, but it proved to be a little bit too difficult for the market. It couldn't quite get to that 6,100 level, which I think was important. Above 61.25, 61.50, we could have been looking at a pretty serious further melt up as an accelerant, as the market accelerated away from these long gamma levels. But it was too much for the market to bear. And at 60.90, I'd probably given some of the froth that we've seen out there in some of these parabolic moves. The market gave back. And guess where we went? We went right back to that strike. 60.55, we dipped below a little bit, and we're stable there, right? So these long gamma levels are acting as stability right now. Worth mentioning that this is one piece of the puzzle, right? This is the kind of stuff that can work until it doesn't. But there's no question, there's a lot of positive support out there for equities. And that's even putting aside all the other stuff that we already know, the corporate buybacks, which are about as big as we've seen in a very long time. Let's take a look at that. Let's look at some of these flows here before we get into some specific option stuff. So here's the gamma that I'm talking about. right? And you don't need to know the deep quant version of this stuff. Just know that dealers are long. They have to buy $10 billion worth of stock or futures for every 1% move down, and they equally have stock to sell on the way up. So what that does is it creates that clamp out there. So big, massive gamma levels. And what about corporate demand, right? What about all the corporations that are in there? We're in that open window for big companies going, hey, I got nothing better to do with my money than buy more of my own stock. Great. Not very interesting, not very inventive. Apple does it all the time. Are they innovating anymore? Not a whole lot, but I'll tell you what they're good at. They're good at buying back their own stock. And so here we are with, you shouldn't complain as a shareholder. You can make money from companies innovating and doing well in that sense. And you can also do well from, companies buying back their own stock. Take stock out of the market, and that means you get to enjoy, the earnings on a smaller float. So year-to-date authorizations, 1.14 trillion, up 17% versus last year. And the idea is that we're going to have massive amounts next year as well. So you often have that tailwind to markets. Look at the flows, 141 billion worth of inflows in the last 4 weeks. So since the election, look at this massive flow. It's very, very concentrated in the US. If you look at things globally, look at this, funds going out of everything else in the world and flowing into this Trump bump, this idea that this is going to be the environment to be in. Maybe also because maybe you have a bit of a higher for longer angle to this, right? Maybe interest rates don't come down as much as we think. And that sort of puts a lot of pressure, upward pressure on the US dollar versus other, the Canadian peso. Sorry, I'm from Canada, but the Canadian peso is just going to suffer from that and many, many other reasons. So the US dollar, very, very strong. It's just a very, very popular place, has been, and it still is, to put your money even for people around the world. So massive, massive flows into equity markets. And so what does that mean? Well, we've got this situation here. We've got this collar situation that's going to run into the end of December. That's when that's when the collar expires. They reposition for the next one. They do this every quarter. And then from that perspective, the gamma is a bit clear. I like to call that you're free to roam. The market is free to roam about the cabin at that point because it doesn't have these sort of underlying forces, right? Some of the stuff we're talking about today is under the hood. And so what we're facing here is a low liquidity environment generally, right? We've seen some very low volumes. About a week ago, we saw some of the lowest volumes we've seen in many years in the S&P. And they always say, don't short a dull market. You got to be very, very careful because dull markets like to kind of drift up, especially into the seasonal. So what do we have here? Things are actually not super, super positive in the first half of December, but beginning where we have this yellow highlight, we start to see this, this environment where people are kind of taking time off. It's eggnog season. It's time to enjoy life a little bit before we dive back into it in January. And the market just has this ability to often, on balance, to sort of drift up. No guarantees that's going to happen. But from a seasonal standpoint, that is what can happen. So it's just been kind of glass half full, punch bowl, no question. Conference board, consumer confidence. Look at this. Look at the people. We talked about parabolas, all these stocks going parabolic lately. Look at the survey of how people feel stocks are going to do over the next little while. I mean, this looks like a parabola, right? Look at this. I mean, going back to 1988, consumer sentiment in how they feel stock prices are going to perform. Look at this. I mean, it's like it's through the roof over the last couple of years and it keeps hitting new highs. Is that bubbly? Maybe, could be, right? Markets shouldn't go up in a straight line all the time. And they don't. I mean, there's an incredible strength. Look at what people are paying for puts. So 1 month put cost on the S&P 500. right? So this is one measure we can use. We can look at, the VIX looks out 1 month. We can look at 3 months. We can look at 6 months, 1 year. A popular measure is 1 month. How do people feel over the next month? And I think you always have to take that with a grain of salt, because a month from now, we're just getting into January, so things are probably going to start ramping up. But there's a lot of kind of in between. There's a lot of probably not a whole lot going on in theory. And so, but the fact is, what people are paying for for puts right now in the S&P is about around where, like, what do we got here? The third lowest over the last couple of decades. So we've only had 2 other times over the last 25 years where puts have traded cheaper than they are now. And so that kind of reminds me of mid-year, where we had 6-month S&P skew. So when we talk about skew, that's the price of puts versus calls. It was as low as it had been in many years, right? So up until sort of late July, when we started to see a little bit of a few cracks in the momentum on the AI side and the MAG side, and then that culminated with August 5th, where we had this little bit of a Volmageddon there, right? When things kind of fell apart quickly. Up until then, we had people disregarding puts, basically saying, I don't need puts anymore. Very, very low skew, saying, I'm not interested in being hedged, which probably contributed to August 5th, right? Because when August 5th happened and it started to gather momentum, guess what? Nobody had protection. And when nobody has protection, they rush to get it, and that can jam that. We saw the VIX up around 65. Whether that was accurate or not, it was definitely at least 50. We had markets widening, so the data isn't entirely conclusive, but people needed to rush in. And so what that is you're buying insurance when the roof is burning, right? You're buying house insurance when the roof is burning. And so that's kind of what happened in August 5th. And we saw that skew absolutely steepen. And then we saw a big rally back. And then people have slowly, but very slowly, because we saw very sort of stubborn levels of fear through after the election. And so people got, people sort of had to pile into protection again, but now we're back to where they're not interested anymore. And that gives me a little bit of pause. I have to say, things are very, very exuberant out there, right? So we have to kind of figure out where we are in this. If some of you were around in the 90s, Alan Greenspan talked about the market being exuberant, and he was a little bit early. It continued to be exuberant for a couple of years. So there is opportunity. Bitcoin, there is, we did a great show last Friday. We did our dollar shots show. So we were picking great names where we could find options for around $1.50, where we thought there was big upside potential. We're going to do another one this Friday, by the way, which is going to be fantastic. We're going to try to make this a regular thing, because people are excited about this idea that you can potentially turn $1 into $2-3, etc. So very exciting. And I think that can work, especially in a kind of exuberant environment. So as long as that exuberance kind of stays with us, my pick was Hood, right? So I love Hood. I think it's a fantastic company. It's had a little bit of a run up, but I think it has everything in the right place, right? It's going to capture all that money, all that inheritance money, all that young generation, Gen Z money, and they're doing all the right things, right? Young people don't want their father's stuffy Fidelity broker, right? They want to do things on their own. They've got the tools. So that was my pick. I was in the lead at some point. I got to take a look here. Let me take a look. Where are we in the, let's see. Yeah, we still got, S&P's pulling back a little bit here. Let's take a look at Hood. Yeah, Hood's pulling back a little bit. So I'm definitely not going to be in the lead at this point. But one of the plays I want to show you guys is I did a coin play, right? So what I did was I looked at implied volatility. So implied volatility in the coin space, of course, has been very, very high. So in MSTR, Coinbase, some of the miners, the riots, the CLSKs, Mara, has been, and that implied volatility tends to get really high when those things rally. So the interesting thing about the whole Bitcoin complex is the implied volatility is very inverse to how it usually works. Usually when the market goes up, S&P volatility comes down, right? The VIX comes down. It's an inverse correlation to the market. S&P goes up, the VIX comes down. S&P comes down sharply, the VIX goes up. And so they kind of move in opposite directions. With things that are considered sort of a safe haven, place to hide, Bitcoin, gold, things like that, silver, most of the time, you get this ability to take advantage of volatility. As these things rise, volatility rises with them because people are scrambling to get in, they're excited, they don't want to miss the boat. These are explosive products, explosive assets. And call skew especially starts to really, really steepen. And so let me show you a little bit how that looks. So you can look this up quite easily. So let's look at MSTR, for example. MSTR. So if I look at skew here, this is a really cool kind of tool for you to have. If you're an option seller, option buyer, you want to be aware of skew. This is kind of one of those things under the hood, right? There's sort of that top line stuff, where's implied volatility, what's the stock doing? And those things that's great. But if you start to look underneath the hood, you get a little bit more granular, it's a bit sort of micro as opposed to macro. And you can see that anything below this zero line means that calls are more expensive than puts. And so what you're going to have most of the time, if I give you something like the SPY, you're going to have the opposite. See, the zero line is down here, and all the time, not just most of the time, index is high put skew. So puts are always more expensive than calls. If you were sort of look at a 25 delta versus 25 delta, puts are always more expensive on an implied volatility basis than calls. And so what you can do is, and that goes for most indexes, sometimes you'll see the Russell kind of invert, and you might see something happen there. But typically for stocks, NVIDIA, I remember ahead of one of the earnings reports, really steep call skew. So these things can get a little bit crazy and wonky for certain things. But in the S&P, you're never really going to see things invert. So you have puts very expensive versus calls. But let's go back to MSTR. We have got safe haven put skew, right? So the calls are more expensive than the puts. And so right now, we put this out in a note I presented with Licia on Monday. We talked about what can we do with our Bitcoin proxy positions, right? The vol's pretty high still, not as high as it was a couple of weeks ago, but the vol's pretty high. They're expecting a lot of movement in these things, as you'd expect. What can we do? And so we talked about some covered calls. We talked about selling covered calls on MSTR. If you own that, if you want to continue owning it, of course, you have to understand what that thing is about. It's a levered play on Bitcoin. MSTR is worth what, 2.5 times the underlying Bitcoin holdings, but they have this great game going on, issuing these convertibles, and people are picking those up to do the vol arb on the embedded call and all this kind of fancy schmancy stuff. But it is definitely where some people want to be when they want beta to Bitcoin. If Bitcoin's not fast enough for you, MSTR is going to give you what you want, right? It's steroids on steroids. Then if you want to get into MSTU and MSTX and all these levered parts, you've got more beta that you can shake a stick at. So they've given us, bless them, they've given us all these incredible ways to make money and to, of course, get ourselves into trouble. So, but right here, we can see calls very expensive. And I said about a week and a half ago, I said, if we get back to that zero line, which is basically calls and puts being just about equal, that's where I would say you're a little bit more neutral on this thing, right? So it tends to blow out to the upside. The call skew blows out, gets very, very steep to the upside. And then as the call skew comes down a little bit, the volatility in that name tends to relax a little bit. And so right now we're getting that call skew a little bit steep again. So people are basically saying, on the one hand, they're saying, I think there's a bit more upside in this thing. They may or may not be right, but they're saying there's a little bit more upside in this thing, and I'm going to start paying up a little bit for those upside calls. And that can happen too when volatility comes down in general, because the at the money gets pushed down and the call skew gets pushed up. So that's kind of the situation there. And so what I said was, with MSTR around, where was it, 385, you could sell a call 11% out of the money in Jan and get about 11% premium. So your call away return was over 20% for something that you might be interested in continuing to hold. Now, Alicia talked about, there's some levels here on Bitcoin that we need to respect before these things come under pressure. So right now, I would be waiting for a little bit more stability. We see this, if you want to take IBIT, for example, we're heading back to levels. Bitcoin's heading towards that 91,000. I don't think that's an area to get too worried about. I think we could bounce there, because my thesis is that we probably stick around that 100,000 level, right? It acts as a bit of a magnet, almost like that collar. This is a big 100,000. So many people have owned this thing for years and years and have said, if it just gets to 100,000, I'm gonna sell there. So we've got this level. It's been a bit of a magnet, and let's see here. Slide number 8. Let me just make sure you guys have this. Let me make sure I am sharing the right thing, folks. Where's my Vimeo here? They always make this so hard, don't they? Where are we going? All right, we'll just stick with. But basically, we've got this level here, this 90,000, 91,000 level that we're going to need to kind of hold. Otherwise, we could see volatility start to erupt again. But as you can see, volatility continues to drop. So let me just see here. Sorry, guys. All right, so you should be able to see my whole screen here. Can you see it? Christian, are you still seeing slide 8 or? All right. Okay, guys. So let's talk about, we've got this. All right. So let's look at some charts here. Tesla, we nailed that 400 level again. We hammered out some puts yesterday on that sell-off. Probably, for me, it probably feels a little bit safe. I feel like that 400 level, again, I like to think of terms in terms of magnets sometimes, and that 400 level has really been a magnet. I think we make it to that 415, that previous high. If you look at Tesla on the weekly, we've got that previous high of around 415. I think we've got a pretty good shot at getting there. So let me see. Let me see what everybody's got. Sorry, guys, just trying to look, dealing with some technical issues here. Just want to see what The producers are seeing, okay, I can see you going back and forth. Okay. So basically, if you look at the implied volatility, which is, this is interesting. So look at MSTR. It's coming off today, and the implied volatility keeps dropping. That's the blue line here. And so it's very inverse to how things typically work in the market, right? When stocks come off, we see implied volatility increase as fear levels get more elevated, right? So here we are, we've got this implied volatility coming off. That will, if we get a real flush, we'll probably see that stabilize, because movement is movement. If you get some big movement in this whole coin complex, you're going to start seeing these option levels start to pick up again. And my idea is that over the next couple of weeks, we probably bounce around that $100,000 level on Bitcoin, and we continue to see volatility come down. So we've been selling some premium in Coinbase. We had a position on MSTR as well. Took that off when it got to around 440. Just because that's not a name I'm as comfortable with. I like to play it if I'm seeing the skew very steep and I feel like there could be a little bit of a collapse, which is what happened. But something like Coinbase, it resonates a little better to me. It's a picks and shovels kind of, it's the CBOE kind of cryptocurrency. So it feels a little bit more reliable, tangible to me. Not to put down MSTR, but the coin just feels a little bit more like a name within the complex that feels right to me in terms of something to play. Not that it can't go down, but it's going to benefit regardless of what Michael Saylor does with his convert trick. So anyway, still playing the compression of vol in the coin complex. I think that's kind of an interesting spot. I think Reddit is still an interesting play. I think it's pulling back a little bit. It's come back about, oh, look at that. It got up to 175, pulling back to 160 again. So we've got just a little bit of softness in the market here. S&P pulling back from its highs today. So we're sort of sitting, maybe a little bit closer to the lows. So we're hoping that gamma continues to kick in and be supportive of markets here. My guess is that it will, and that we're not going to get too far to the downside and probably not too far to the upside. So I don't see a lot more movement happening this week. So Tesla's still looking pretty good. Costco pretty good. Netflix, I've got one of my cash machine trades on, so selling some sort of in the money calls, grabbing that implied volatility, but also getting a little bit of a hedge there as well. So that's really worked on a few different plays. And Visa as well. Love Visa. I think you've got to spread your risk out, right? You can't just be in tech. You can't just be in the Bitcoin complex. You got to get into some other things. Home Depot, Visa, some sort of broader, wider kinds of names. We've been playing Ulta Beauty. Here's one. If you don't think boring value type stocks can do well, look at this thing, got down to 335. We were short some puts, had the stock put to us. The thing runs up $130, $120 after that. So we've had some big moves, even in kind of boring type stocks. In terms of some short deltas, I always like to have a little bit of short delta on the sheets as well. So I'm looking at Target. We've got a short call spread on that's taking a little bit of heat right now. I think that rally fails and it comes back down. Looking at Walmart here, kind of hanging in there. We had our cage match a couple of weeks ago where we talked about Walmart or Amazon. And I just said, you know what? Walmart's done a great job, but Amazon is where it's at. And so Amazon's up about 10%, 11% in that time. And Walmart's pretty much where it was. It got a little bit higher, but got down. So I said, sell calls in Walmart, but don't sell calls. And I'm the income guy, right? I said, don't sell calls in Amazon. Let that thing run. And so I think that's one, we're going to wrap it up in a moment, but that's one of the things I want you guys to realize is that when you're an income trader, whatever you're doing, whether you're selling cash secured puts, you're doing covered calls, always try to have the big picture in mind, right? Make sure you see the forest and not just the trees. Don't get stuck in the noise. It's very easy to do that when you're trading markets. You're watching them throughout every day and watching every tick. Sometimes it's almost better to be, to step back and not see things as closely, but you can get caught up in the noise. And I looked at Amazon, I said, this is an unbelievable company trading at a valuation that's close to Walmart's, unbelievable cash flow, starting to revert back on a lot of fundamentals. I like to look at fundamentals as well. So coming back and all those incredible metrics that I like to look at, return on invested capital, all these things that help to support your thesis. And I said, this thing is going. If you can get through that Amazon, that Bezos call wall at 200, I think it's got a shot at 225. So at the time, the stock was in the low 200s. And I said, no, don't sell calls on this thing. And so I think you want to realize that there's a time to do certain things and there's a time to let the market do the work for you. And I wanted to let Amazon do the work for me. And it's not that I'm Nostradamus and I knew where Amazon was going. Maybe it could have gone down $15. Who knows? But there comes a time where you just have to go, listen, I'm going to wait it out. I want to be given some edge. So I always tell this story. I say, listen, I used to run about $700 million in cover call funds and option overlay funds, just trying to do this kind of stuff. And I would say to advisors, they'd say, well, how are things going? I said, what do you think about cover calls? I said, well, you know what? My base case is I don't want to sell cover calls. And they sort of look at me like, what are you talking about? That's what you do. And I said, yeah, but sometimes if I'm not being given edge and volatility levels are starting to get a little low again, right? 12, 13 on the VIX, you're starting to get very low, thin levels of volatility in a market where things just are trending up. You just have to realize that sometimes the edge is in just riding a good stock. And I said, if we can get to 225, that's where I'm going to be interested and compelled to start trying to generate a little bit of extra income on there, using my Amazon, rent it out and get those call premiums. And so it worked out. Amazon's been doing great. It's had a good run and it tends to pull back $10 to $15 after it has these runs. So I think it's a good time to maybe add a little bit there. Premiums probably could be a little bit better. But anyway, that's your takeaway. Hopefully one of your takeaways from today is, let the stock do the work for you sometimes, because that's why you're getting involved in good stocks, right? Why did you buy Amazon? Did you buy it to cap your performance up $3 or $4? No, you bought it because it's a great company. And if you're not buying great companies, good luck to you, because you're going to have to stick handle those, very, very well. But if you're getting into good companies, let the companies do the work for you sometimes. So that's our little Amazon Walmart story. And hopefully we covered a lot of stuff today for you guys. And we will see you in the next show. Again, Friday, we've got dollar shots. We're going to be doing that again. We're going to come out with Mark, Andrew, Licia, and I are going to come out with our picks for our dollar shots. And we've got a full schedule of amazing shows all week long and lots of ways for you to get involved. So look into it, check it out. Also, my newsletter, sign up for my newsletter if you want to hear more cool stuff like I've been talking about today. I go over everything from a vol trader standpoint, from an investor standpoint, and you're going to get a really nice chunk of info every time you open up that newsletter. So sign up for that. We'll have that in the chat, and we'll see you guys next time. Have an awesome week and an awesome day.